Good morning, my name is Przemysław Kwiecień. I'm Chief Economist of the XTB and you're watching our Monday weekly webinar. The title for today's meeting is Will Debt Bury the Markets? Okay, why asking this question, you could say, with markets rallying to fresh all-time highs for the major indices like US 500, US 100, D30. We have all of this morning, but I think in times like this it's even more prudent to ask these questions. So this will be the story for today, but obviously we are going to discuss much more, including the latest NFP report and why it didn't hurt markets even though it was fairly weak. Draghi as Prime Minister of Italy, the end of short squeeze frenzy on US stock market, including stocks like GameStop, AMC, Nokia and others. US tech results that were really strong in Q4, but why this is not only good news. No inflation pressure in Europe, but inflation pressure boiling in the US. And finally, last but not least, Bank of England attempts to reverse market bias towards negative interest rates and how it impacts the cable. So there are quite a few topics to discuss, but let's start from this major topic that I announced at the beginning. Will debt be a real problem for the markets this year? It very well could be. Why? Let's start from the public debt in the US, which wasn't really a problem in 2020, even though there was a record deficit, post-war deficit in the US that had to be somehow financed as the economy plummeted and as the federal government spent trillions of dollars on aid packages. However, it was all supported by the Fed that said, look, we have to have markets functioning, and under this label they were able to increase their balance by more than 3 trillion of US dollars, as you can see here. So they really could do limitless things. Only in March they increased the balance at about the pace of $1 trillion. This cannot be replicated this year because they already are on a certain path of easing that they promised to deliver, which is still huge, and it's $100 billion each month. So this is still huge QE, especially if compared to anything we had before the pandemic. But even with this QE and even without any tapering that could take place later this year, and why it could, let me tell you in a few minutes, the gap that needs to be financed by US government is much wider. As you can see, it's nearly 3 trillion, more than 2.5 trillion US dollars, and that's because we have this Biden package that came on top of the previous package agreed when Donald Trump was still the president of the United States. And obviously that's a lot of money that will hit the economy, but that, again, at the same time, this will need to be borrowed somewhere. And last year it was fully financed by the Fed, even more than fully, because the Treasury was able to build some cushion of cash with the help of the Fed. And obviously we have this duo of Yellen, Powell that talk to each other, and I'm pretty sure they consider how to do that. But unless they figure out something like, let's say, yield curve control, something that they said they would not done, then it's going to be a problem, because financing this gap on the markets, nearly 1.5 trillion US dollars, it's going to be problematic, and it's going to rise bond yields in the US, something that we already witnessed. As you can see, let's take a look at the extension platform, and you can see bond prices in the US. The yield acts reversely to the price. So if the bond price declines, the yield increases and the cost of money increases. So even though the Fed maintains 0% official rate, short-term rate, then the longer-term rate increases, and that has an impact on home buyers, on debt, on someone who needs to release new debt, on obviously on the government, and more participants in the economy. So obviously this is not going to support the economy if this trend of declining bond prices and therefore rising yield prices continues, and that's the real risk that happens here. Moreover, if you if you, I showed this a couple of times before, I don't have a calculation here for you, but if you had any equity valuation model like DCF, they have discount rates that are that come from the bond market. So if bond yields increase, these model valuations also decline, and that's going to be a problem for analysts. Obviously, right now they're under pressure to rise targets because obviously the market's rising. So you don't tell your clients, look, sell. No, they need to rise valuations as well. But from the model perspective, it's going to be more and more problematic. So that's the first challenge that's going to take place. And second, debt is not only rising on the public side, but also on the private side. And the last couple of weeks, I discussed a lot option market. That is an issue for the US because that's a lot of risk out there. But as you can see here, it's not only the option market, but also the margin equity buying market, where people take more debt to buy more equities in the US. And you would wonder why they do that. You know, rationally, if you have a portfolio of investments and you can see your portfolio ballooning because obviously the prices are rising, then you think, okay, maybe let's take some profits, let's pay down some debts, like make it more sustainable longer term, whatever happens, because many things may happen. But that's not the case. You know, people are adding more debt in the US, buying more equities, pulling this market higher. But if conditions deteriorate, they will be forced to pay down this debt, and obviously that's going to add on the selling pressure somewhere in the future. So this is a long-term indicator. Obviously, as you can see, there are not too many swings in the short run. There are, you know, more than 2 decades on this timeline. But as you can see, it rallied sharply in the dot-com market and then crashed. It rallied sharply in the market that was mostly, you know, the home market, the house building market, and then the credit crunch in 2008, and then it rallied further and then interrupted last year at the pandemic, but really did not pay down on that much as we saw during those bear markets, the real bear markets that we had before, and then it exploded with the support of the ultra loose Fed policy. It exploded to the new high. So obviously this is concerning, and this is just another red flag for us, telling us, look, this market obviously is looking great right now, but it may end in tears. And another look at this. This is the relationship to the GDP. So you can see that more than 3.5% of the US GDP is now in credit for equity purchases. Whereas here you have this margin dynamics, and as you can see again, a sharp rise. So it's not just the level, but it's also the dynamics of the change. Whenever it was so high as it is today, it usually was a signal of the late bull market. Another indicator that's worth looking at is a breadth of a market, and here is MSCI World. And again, if you take a look how many stocks beat the index, you can see that usually if the market is narrow, so if there's just a few stocks doing most of the heavy lifting, whereas the other stocks are lagging behind, as it is the case right now, it's usually a sign that the market might be peaking. Obviously, these signals are not like in mathematics that it's 100% proven and needs to trigger something next week, but taken together with also the option market that I discussed over the last couple of weeks, that is also having a lot of calls and few puts, all these signs suggest that the market is overheated. And if you look at the indices, this is a great time to hedge your portfolio with CFDs on instruments like US 100 that is on record highs, or S&P 500, US 500, or the D30, depending on which kind of portfolio you have, which stocks you have in your portfolio. It makes sense to use these high levels, you know, when we are, let's say, for me, it's like this trend line here or this channel here for US 100. Whenever we are so high, we're at new highs, is a good moment to hedge your portfolio with a short position here. So whenever the market, even if there is a profit taking, even if it's not a deep correction like we had last time, it wasn't a full correction, you are partly hedged and you can withdraw some of these hedges as the market corrects itself. Obviously it's all subjective, and you can never be 100% sure you know, how much should you hedge, at which point you should close these hedges. But for me, this is a great opportunity to do this, because otherwise you can be exposed to something potentially big and negative without any sort of protection. Okay, let's move on to macroeconomics and discuss the latest NFP report, which was pretty awful, let's be honest. Take a look here at this chart, and it shows you that total jobs market is way below pre-pandemic levels, and what's even more concerning, it shows no willingness to return there. So this shows us that the real economy is way behind the stock market right now. And of course, during the year, this whole stimulation in the US, it may pull these markets upwards to some extent, but it shows that even with the whole package, I really doubt we return with employment to pre-pandemic levels anytime soon. So you wonder why this report was ignored. Well, for the stock market, I would say that the major reason is bond yields, because like I told you, with the bond yields on the rise, this could be a real problem this year for equities, because if the rise in yields is supported by macroeconomics, then the Fed will not be in a position to contain it, right? Because if economy is strong, why easing further? Well, there will be no logic to it. So the market is, so I would say right now, the markets are more scared of strong economy than they are scared of a weak economy. So that's the reality that we're living in. But the jobs market was important for the FX. As we can take a look at the euro dollar. Last week I said that this we could have another leg down, and that's what we had, and we moved to 120. However, this was a strong support here, and with this, let's say, help from the weak NFP report, we had a bullish engulfing here on this key support. So this is pretty strong signal right now. I'm not sure it's a return to the longer term upwards trend. However, it could at least take the market somewhere higher before restoring this downward trend. Why do I think we can have a longer term US dollar strengthening? Well, the key reason is this rise in bond yields, like I said, because here we are looking already at quite strong longer term trend that normally is positive for currency. So when you consider the fact that we have stable and negative yields in Europe, we have also similar stable and negative yields in Japan, then rising bond yields in the US are net positive for the currency. Obviously, there are many things, other things that need to be taken into consideration. However, just from the yield perspective, and also from the perspective that the US dollar is still oversold by speculators, then you would say that this is a strong argument for US dollar to continue rising longer term. However, short term, like I said, I'll be cautious, because also like looking on the euro dollar, also here the dollar index, we had a nice reversal in store until Friday, where there was this here. Obviously the US dollar index is a bit of a reverse of the euro dollar, so here we had the bearish engulfing, and therefore we may move a bit lower, but then let's see what happens. But if this trend in bond yields continues, then we can see US dollar back in action sooner rather than later. And why it could be so is that because, you know, in the US we have huge stimulus package served by President Biden, and this could not be a very good thing for the US economy. Why? The reason is that even without it, we already see some signs of inflation pressure. When you look at the ISM, especially manufacturing ISM, this is blue line, companies, most of them, more than 80% of them actually, they say, look, we are looking at increasing inbound prices, we are looking at increasing oil, increasing energy, increasing materials, and we need to pay for it. So obviously what they would like to do, they would like to carry over some of these costs towards the consumers. Obviously, if the consumer is weak and they do not spend, that's an issue. But if they have a lot of money from the package, even if it's temporary, and if they spend higher percentage of that money, and that's what they do according to the Bank of America research, then this inflation pressure could find the way towards consumer prices. And if that's the case, then we can see this trend in bond yields extended, and like I said, it's going to support the US dollar and it's going to be negative for equities. Let's see what happens, but that's a real risk that needs to be considered. Another thing, like what I promised to quickly discuss tech results, because that's over. The Q4 earnings season for the big tech is now the history, and obviously that's great history for the companies. These are really great stocks like Facebook, Apple, Amazon, Alphabet, Netflix, Microsoft. You can see that sales increases were really stunning across the board. The weakest was Microsoft, which was nearly 17% year over year. So if you compare 2019, which was like, let's say, normal year for the economy, and then if you compare the pandemic year, which was for the whole economy, obviously it was difficult year, then you can see that outside of Netflix, we had every other company rising faster. So obviously this is a huge win for this sector, and that's the reason why these stocks are doing so well. However, having said that, take a look at that. 1 year ago, we had price to sales ratios that were already above the 10-year average for all of the stocks except Facebook, because there is no 10-year average provided, because the history is not long enough. But for all of the other stocks, we had price to sales, which is, for me, it's a good longer term indicator, because price to earnings is much too volatile. But here price to sales was already higher in all 5 instances, and despite the huge increase in sales, the price to sales again in all instances increased, and in some cases increased quite a lot. So that means that obviously the stocks are great, the businesses is great, but the stocks is overvalued. So yeah, like I said again, this is the time to take advantage. If you were heavy in equities, it is a time. It's not a bad opportunity to hedge some of your portfolio. Okay, let's move on to Bank of England meeting last week, which proved to be a bigger event than I anticipated, because you could think, okay, what they could do, they don't want to cut rates, at least right now. They don't want to mess with the QE. So what they're going to do, probably they're going just to communicate something, and they did. But the statement was quite strong. They said they are no longer looking towards negative interest rate, and that's quite strong impulse for the currency, because from the currency perspective, again, what I was saying within this bond yield supporting US dollar, so you have a message that interest rates are very important for currencies. So if there is not going to be negative interest rates for the pound, then that's obviously very good news for the British pound that continues to be on the upwards trajectory, and it could continue at least in the short run. When you take a look at the cable here, you can see that this trend is pretty strong and continues to rebound from 50 and 75-day moving averages. And with the latest week NFP report in the US, this trend can be continued into the future, at least for a while, because then we have these issues with the US inflation, and if that causes a stronger US dollar appreciation, then obviously this trend is at risk as well. But at least in the short run, this message from the Bank of England plus the NFP supports the trend for a while. Finally, we have commodities, silver and oil. So let's start from the charts. And silver, obviously, the short squeeze attempt was done before it started, pretty much. So it lasted one day, and even last week I argued why the attempt was tough to execute, because some of misunderstandings among the participants. That's the first thing, and the second, that silver is much more challenging market. However, having said that, what didn't turn into a big rally instantly could possibly strengthen outlook for silver, because it had very wide marketing effect, and many people understood that they actually take exposure in this market. And as you can see here in this purple line, there was a huge increase in ETF holdings last week. So after a period where it stabilized at high levels, but still, silver is obviously much less popular investment than gold, then obviously in the short run there will be some disappointments. Oh well, it didn't rally, it didn't start, so this is no starter. But for some, they will at least understand, look, maybe that's not a bad idea to put some of my money into silver. So therefore it can have this marketing effect, and in the longer run, at least until we have this supportive central bank policies, silver could benefit from this movement. And the oil market, which remains in deficit, and last week I said Blinken, a new Secretary of State, he said that the deal with Iran was not imminent, and without this supply, the market can be in a deficit for the majority of the year. So when we look at the oil market, we can see that it rallied upwards from this consolidation. So it remains in this strong upwards trend. Obviously, the market is already quite expensive; it's quite overheated. But at least for now, the risk of correction has been minimized. There was a chance here, but the bulls had just no power. With the market deficit, they found themselves in a too tough position to actually trigger some correction, and they had to give up. So at least for now, the market is looking bullish. This week we're going to have a lot of events in the calendar. However, I do not expect them to really have huge market impact. We have US inflation on Wednesday, we have consumer sentiment on Friday, we have Powell speaking on Wednesday. So there are positions in the calendar that are worth watching. However, this is going to be other news that is going to impact the markets more. So please stay with us, track the news section, both Xstation mobile platforms, where we will try to inform you about all of this. This is it from my side from today. Thank you for watching, and we see each other next Monday on 7:30. Have a good week.